Welcome, everybody. My name is Tim Moore, and I'm a financial advisor here at 25 Financial. I also sit on our investment policy committee, and we work a lot with the gentleman you see on your screen here today from Vanguard. We obviously use Vanguard for our traditional investments, and most of you who are clients of ours are very comfortable and familiar with Vanguard. And today we are going to talk about kind of a unique opportunity that is maybe not brand new in our space, but newer for maybe the retail channel. These guys will explain better than I will. The opportunity here with a concept called direct indexing. And direct indexing at a very basic level, what we usually say is it's tax loss harvesting on steroids. And if you're not familiar with tax loss harvesting, we'll talk about what that concept is. But for probably a lot of you are familiar with it. Tax loss harvesting is when you intentionally sell a position that you have an unrealized loss in order to capture the loss for tax purposes. And that's a strategy we've been doing for a long time. This is definitely an enhancement on that, and something that is potentially very powerful for your portfolios and for your taxable brokerage accounts and things like that. So I'm not going to steal any more of these guys' thunder. I want to introduce to you Keenan Graham and Patrick Hogan from Vanguard. Guys, thank you for taking some time to help our clients understand what this concept is and maybe how this could apply to their portfolios. So yeah, just thanks for being here, and I'll let you take it away.
Yeah, of course, Tim. And thank you for having us on another one of these sessions. We're always happy to join and talk, and hopefully try to break things down in a way that makes sense for everyone. But I guess we'll just start. What is direct indexing? I'll just do a little bit of history lesson on how we arrived here, but this strategy has been around for a very long time. Now, a lot of people didn't know it as direct indexing per se, or that title, but it's essentially a separately managed account of individual stocks that an investor holds with the intentions of harvesting losses, Tim, like you mentioned previously, to offset capital gains. One of the things that we find with high net worth investors, they're essentially tax averse. I think most people are, right? People don't want to pay taxes. And one of the strategies that advisors can implement to help investors save on taxes is this custom SMA, or in other words, direct indexing. So how Vanguard arrived here, we're one of the preeminent faces of indexing. Just knowing our history, we're really big on indexing, and we're really big on low costs as well. So as costs started to come down for a strategy, technology improved over time, we really saw the opportunity to offer a solution to investors where they get increased high technology that's going to be able to automate a lot of these processes for them. They're getting lower costs in the space. And based on our due diligence and research, we found it to be a real benefit for certain types of investors. So we can talk a little bit more about that later as well.
Right.
So I'll end it by saying, when you think about the indexing and direct indexing, just like an index fund that you would hold that tracks, say, for example, the S&P 500 or a certain part of the market, this strategy is seeking to do the exact same thing. The only difference is, instead of holding it in a mutual fund or an ETF wrapper, you're going to hold the underlying individual securities of that respective index or that benchmark. So I'll just share a quick example of what I mean by that. So you think about the traditional structure of a mutual fund or an ETF. Everyone knows that they hold that package. They know that they hold and have exposure to the underlying individual securities of that package, right? But you don't see all of those individual securities in your account. You just see that one ETF or mutual fund wrapper. Well, with direct indexing, the investor directly owns each individual stock. And the reason why that matters is because that gives you more opportunities to harvest losses to offset potential gains in the account and other areas of the investor's life.
Right. Yeah. And so like a good example of this is like the last time we were really able to do some pretty comprehensive traditional tax loss harvesting for our clients was back in the end of 2022, because we had, it was a really down year for the overall market. I think the S&P was down like 20+ 5%+, something like that, and NASDAQ even more. So a lot of our ETFs did have, if they were recently purchased, did have some losses that were able to be generated. But there's really been nothing we can do on that side in the last 2 years because we've had just very strong back-to-back years. So that's a good example to your point, like, hey, just because the index is up doesn't mean you can't potentially capture some of those losses in this separately managed account.
Yeah, I think that's a fantastic point, Tim. And especially these days, right? You hear a lot about the Magnificent Seven stocks
Right.
or the stocks that are responsible for the majority of the S&P 500's return. Well, if you hold a mutual fund or ETF that's tracking the S&P 500, it's more than likely up year to date, right?
Right.
But we know not every company in the S&P 500 is up year to date and performing well. There are companies that are not performing that well. So with the mutual fund or ETF wrapper, you don't have the ability to take advantage of those losers in the S&P because those seven stocks are carrying it. Well, with direct indexing, you do have that ability because you hold each individual stock outright. So you can let the Mag 7 do whatever they want. You'll still participate in that performance, but then you'll also be able to capture those losers in the index and really save you a lot of money on taxes.
Right. Fantastic.
So I'll stop sharing my screen there. So that's essentially the what direct indexing is. Now I think the important thing to keep in mind, Tim, you mentioned being able to go in. This was a very manual process for a lot of advisors. What this does is help advisors assist their clients in a more efficient way because now they're implementing technology, they're able to capitalize a lot quicker and a lot more efficiently on those market opportunities and those dips that we might see in the future.
Mm-hmm.
So pairing this technology with your advisor's expertise is really going to help you out. And then your advisor is obviously going to know your tax situation and the other investments that you're utilizing to pair this strategy with that and help you save a lot of money on taxes. So that's the primary use case of direct indexing that we see mostly is tax loss harvesting, saving money on taxes. But there are other use cases that I'd be happy to discuss as well, if you'd like.
Gotcha. Okay. Well, one question that I think I've heard a couple of times from clients is, well, they get kind of confused and they think, oh, are we now picking stocks? Like I thought we were passive investors and just we believe in index funds. Like to your point with Vanguard, I think they get kind of confused by now we're buying individual names instead of
Mhm.
just an index fund. Can you speak to what sort of decisions are we making when we decide to potentially do an investment in direct indexing?
That is a great question. Now there are other direct indexing options out there where maybe they are selecting stocks or it's more of an active approach. In true Vanguard fashion, we are truly indexing with direct indexing. So we're really taking advantage of that indexing component of it. And essentially, you go in and you select whatever benchmark you want to track or index, meaning the S&P 500. Some people are familiar with Dow, just as an example, right? We don't have
Right.
Dow available or NASDAQ. You can track whatever you want to track. And essentially, the names that are going to be in your portfolio are the same names that are in that respective index.
Okay.
So we are not actively trying to find winners or losers. You are holding the names in whatever index is being tracked, just like you would in a mutual fund or ETF. That's also an index product.
Right.
So whatever securities get included in the portfolio, we're going to talk a little bit about wash sale rules here shortly, will
Okay.
be names that are in that respective index. We would never include a name in the portfolio that is not in the index or benchmark that the client or an advisor have decided they want to track.
Gotcha. That makes sense. Yeah. So speaking of that, so like you might be asking, okay, so I let's say I buy Coke and it's down 10 or 20% and I want to capture that loss in this direct indexing account. Well, most of you know you can't just go and immediately repurchase Coke. That's going to trigger what's called a wash sale, and you basically will not get your tax deduction for that because you were buying the exact same security. So what do you do in that case? Do you just have to wait a certain amount of time, or how does direct indexing work when we do capture that loss and we realize that? How do we stay participating in the index?
Yeah, the beauty of that, Tim, is we replace it with a similar security, right? So you mentioned Coke. Well, maybe we put Pepsi just as an
Right.
example in the portfolio. And the technology knows that once something is sold, it can't be bought back over that 30-day period. So
Hmm.
you'll be protected on the wash sale rule automatically. It's built into the technology algorithm. It knows when something's sold, hey, it's on a restriction list and it won't be bought back in the portfolio for that
Right.
period of time.
Gotcha.
So the ultimate goal and what the technology is trying to do is trying to make sure it can harvest losses in a reasonable way for clients to help them out from a tax standpoint.
Hmm.
But it's also looking to track whatever index or benchmark you've selected as closely as possible, just like an index mutual fund or ETF would do. So really tight tracking, so we make sure your performance is as close to that index or benchmark as possible, while also balancing um, tax loss harvesting and helping clients save money on taxes. So that's the dual mandate of the technology. And I should note as well, in addition to the technology, we have humans evaluating it every single day.
Okay.
So you have humans evaluating it every single day in conjunction with the technology, make sure everything looks good and that we're maximizing the opportunities for clients from a tax standpoint.
Great. That's fantastic. Okay, so can you set some sort of, and it's hard to say what will happen as far as like expected performance of this type of account versus if you were
Sure.
just to hold the S&P 500 index fund. But what have we seen since Vanguard's been doing this? What sort we would call it the tax alpha, right? So like you
Yeah.
would expect to be able to, okay, if you're trying to track the index, you want to be as much as you can in lockstep. If the index is up, 8%, 10%, 12%, you'd like to be doing about as well just in your performance. But then you have the alpha of the tax loss harvesting. What
Mhm.
should clients expect, and what do those returns look like? Does it happen pretty consistently? Does it happen all at once? Do you have to wait for a really bad year in the market? What sort of expectations should our clients have as far as what this will do for them?
Yeah, it's a really good question, and it's a little nuanced because every client is different. And the great thing about direct indexing is we're taking into account each client's specific tax situation. So Tim, as you know, you as the advisor, you can go in and input the client's federal, state, local tax rates.
Hmm.
It's going to take that into account when trying to manage and generate the after-tax alpha that you mentioned. And when we talk about after-tax alpha, all we're really looking at is what the performance of your account not having paid taxes, essentially, because we're offsetting that, right?
Right.
Versus the performance of your account if you were to pay taxes.
Right.
So it's really looking at each client's individual tax situation and saying, hey, your after tax performance would be very different if you were actually paying the taxes versus the performance not paying the taxes and assuming that, hey, if you have extra money not paying taxes, you'd be able to put that back into the portfolio. So
Right.
we're really looking at the difference there. As far as performance, with the tight tracking, you would expect performance to be in alignment with whatever index or benchmark you select. So if that was the S&P 500, we'd expect performance to mirror that. But the neat thing about it is, Tim, you'd be able to show clients the after-tax performance as well and say, hey, here's how much money you didn't have to send to the IRS, and here's the tax alpha that was generated by the account because of it.
Correct. Yeah, so that's a really good point. So yeah, you'll be able to see how they track with each other, like Keenan mentioned. And then so for our clients, honestly, the higher of a tax bracket you were in, the more potential there is to save on that tax alpha. So so that you can kind of, we plug those numbers in and we make sure that it makes sense for your tax bracket, for your situation. This is also the important thing to note. I think I mentioned at the beginning, this is not for an IRA or what we would call a qualified account. This is for a taxable account or a brokerage account, because we want to capture those losses. And it would be pointless to do that inside of a tax deferred or tax free account. Is that correct?
That is correct. We mostly see this in taxable accounts unless there's some other reason that they're utilizing this strategy, but it is primarily meant for a taxable account to help you out on the tax side.
Great. And one thing I'll say is, you have the option we have the option to, we've worked with Vanguard. We've actually been able to change the settings and make sure things are optimized correctly to really fit really nicely with our existing Vanguard portfolios, with all the different tilts and our preferences for value and some of the other areas that we really feel like we can get some good diversification and strong returns for our clients. A couple of limitations of this account. Number one, I do understand it really is not tax or cost effective to do any international stocks in this account because of some the things that really drive that price up. So we really look at this for any of the domestic sleeve of our portfolio. Would that be a correct statement?
It would be. It would be. Getting the international exposure is a little bit harder, and it's possible, but like you mentioned, would incur some higher costs and
Right.
fees to do that.
Yeah.
So typically what we see is on the US equity side, and one of the other use cases I kind of mentioned earlier is the customization that it affords you. So if you as the client, if you already have a lot of exposure in healthcare, you have a lot of exposure in energy, whatever it may be, those are things that can actually be excluded from the portfolio totally. So your advisor can really help you be targeted and create portfolios that make sense for you.
Right.
So when I really think about the individuals that are suitable for this, you're thinking business owners, right? Especially if someone's going to sell a business in the near future. When you sell a business, you could incur a huge capital gain. Well, having this direct indexing strategy running for you prior to that sale is going to help you harvest losses that you can carry forward indefinitely. That's one thing we didn't mention on the call, Tim. You can carry losses forward for however long you want,
right?
Up until you sell the business, and then help offset a portion of that gain from the sale of a business, as an example.
Right.
Or maybe you have a lot of real estate. I love real estate. I'm a nerd when it comes to it. I live on Zillow, Redfin, all those things.
Yeah.
But if you're going to sell homes or investment properties, you're going to incur a capital gain. This strategy will help you out with that. So
Right.
those are just a couple of things to think about for investors out there.
Yeah, that's excellent. That was going to be kind of the next point that I was going to bring up, that, really think about this. This is used to offset any sort of realized capital gains. So it doesn't have to just be in your publicly traded stocks and bonds portfolio that you're offsetting here. Think about a lot of our clients came to us initially because of access to alternative investments and some of the real estate projects that we have. So when those things cycle and you're going to get hopefully a very nice return that you're going to realize, you're going to think that's great, but I got to pay the taxes. Well, this is the way to kind of mitigate some of that and to help strategize, all while taking essentially the same amount of risk that you would if you were just investing directly in the S&P, whatever index you're tracking. So that's a really powerful tool as well. Talk about, let's see, what I was going to ask is this, how do I invest? Do I just need to take like new cash and invest in this? What if I have an existing portfolio inside of my brokerage account and I want to maybe allocate a portion of that to direct indexing? How would one go about, what do they need to bring to the table to get started with direct indexing?
Sure. There are a couple of ways. You can do it with all new cash, and the minimum for this is 250,000. So with as little as 250,000, you could have that in the account. Work with your advisor, select the benchmark. You're off to the races, and you're participating in market performance. All the while, we're trying to take advantage of those harvesting opportunities for you.
Hmm.
Or maybe you have a ton of highly appreciated securities. So you have stock that you've held on to for a very long time. It's appreciated and grown, which is what you want it to do.
Right.
But you're nervous because if you sell it, it's going to incur a huge tax liability for you. Well, what we can do is we can actually analyze the cost basis or what you pay for that stock versus what it is now. And then we can determine the best way or most tax efficient way to sell down that stock over time, if that's the ultimate goal, and then transition you to a more diversified portfolio. So the great thing about it is if you're an investor and you have concerns about how much your stock has appreciated and the tax bill that you'll be on the hook for, this strategy will allow you to sell it down over time in a tax efficient way, help you become more diversified. And that's one of the big benefits of direct indexing and our technology is the ability to take a current portfolio, analyze it, and transition to a more diversified one.
Got it. Excellent. Yeah, that's really great. And so is this like a, set it and forget it type strategy? Is it something that we should be revisiting? Like once we've opened up the account, should we be adding to this account? Should we, talk about the flows? Is what's the, what are the options here? And is there a best option?
I'm glad you brought that one up. And I'll say here's one of the downsides that we hear about direct indexing is that if you don't contribute any money to the account and you let it sit there, over time, once we've been able to harvest losses, let's say over 3, 5, 6 years, the account's going to become what we call ossified is the formal term for it. But
Hmm.
essentially all that means is that your stocks have appreciated so much that there are no longer any losers in the portfolio to harvest.
Right.
So at that point, direct indexing kind of loses its appeal. Well, one of the things that can really help out with that is going to be consistent contributions to the portfolio. That's really going to delay the point at which it becomes ossified.
Okay.
And for the record, the ossification, it happens years. It takes years for it to happen.
Right.
But by contributing cash to the portfolio, you're able to get new lots, different securities in it. That's going to help delay that point, and then we'll be able to harvest a little bit more.
Right. Gotcha. Yeah, that's really powerful. Okay, so it's essentially, so you can do a dollar cost average strategy inside of this type of account. Not, it doesn't have to just be a lump sum only and never touch again. It actually can, like you said, it can extend the life of that active tax loss harvesting by adding more to it as you go. And then let's talk about, kind of I always like to think, well, what's the end game? What's the ultimate point? So at some point, whether it's when you retire and your income goes waste, you're not going to add any more, that account's just going to be sitting there, or you decide, okay, I think I've got enough in my taxable account. I really don't want to add any more there. I want to do some other investments. How do then, so we've got these, highly appreciated holdings. What are some strategies at that point? Obviously you can sell them and pay the taxes you're pay the taxes at that point and just realize that, or there's some other potential things like something you've mentioned is if you leave it to your state, you get currently the benefit of the step up in basis. So that would be a benefit for your heirs in this type of account. Other potential is if you're charitably inclined, donating appreciated stock, and that's something you could certainly talk with your advisor about. Are those kind of some strategies you guys have seen in this that it solves the quote unquote problem of these highly appreciated stocks in this bucket?
Totally. And I'll say the options out there are getting even more sophisticated than that as to how to deal with the ossification of an account. So
Mhm.
honestly, the ossification or those stocks becoming so appreciated that we can't harvest isn't as much of a concern as it used to be because of some of the things that you mentioned. If you're charitably inclined, you can donate a highly appreciated stock. I think people often forget that, a lot of times when they retire, they're in a lower tax bracket, or maybe there's a
Right.
year where they have really low income. You can sell it at that point and possibly pay zero capital gains
Right.
tax, depending
Yep.
on how much income you made that year. And then there's also, of course, passing it to the next generation. and receiving the step up in basis. So there are a lot of options out there for people who have accounts that have run. Or maybe you decide, hey, I don't really need tax loss harvesting at this period in time. You can remove the account. It's, as easy as a click of a button to have it removed from the strategy. So there is no lock-in period. You don't have to commit to doing this for any specific time. And that's the beauty of it as well. There's no penalties for getting out. We want you to be able to use this strategy whenever it makes sense for you in conjunction with your advisor. And then if it doesn't make sense, totally fine. You can remove it and then decide what to do with the securities from there.
Yep.
And the other thing I'll note is our team is really great at being able to work and help investors identify which lots of shares to donate, for example, or which lots of shares it would make sense to sell. So, you're partnering with Vanguard on this. You got access to our team who can really help you with more complex investor situations to determine what makes sense.
Great. Yeah, that's awesome. Great. So let me kind of give a brief recap of, I think, what we've talked about and make sure that everybody understands the high level what we need to know. And then if there's any other kind of final thoughts to add to this, feel free. So 250,000 is the minimum to invest. This is a liquid investment. So these are just like holding index funds or individual names. You're not locked into it. The only thing we are sensitive to is just the tax implications while we go through this. But yeah, this is just as diversified. And like the index, 250. What are the costs and fees associated with doing this strategy with Vanguard?
Yeah, I'm glad you asked. We didn't touch on that. So it's going to be what we call 20 basis points, essentially, is what it starts at. And Patrick, I don't know if you have the actual fee schedule pulled up there, but essentially, the more assets you have as a firm, the lower the overall cost. So there are breakpoints where if you have one really large account, we could give a discount. So there are different ways that you can do it, but it starts at 20 basis points is what I'll
Got it. Okay.
share
And
there. We can
just for comparison, our Vanguard index funds are, would you say, what, between 5 and 10 basis points on average? So, we're only talking another 10 to 15 basis points, which, we want to be cost conscious, but think about the potential benefits you get on the tax side. That's why we believe this is a worthwhile endeavor for a lot of our clients. It is worth the slight added expense there. Okay, so we do all that. We can bring new cash to the table. We could bring an existing portfolio that we would potentially transition into direct indexing. And then we hold this at Charles Schwab, for example, just like we hold the rest of our clients' accounts, and we simply just give Vanguard the access to trade in that account on our client's behalf. There's nothing really we have to do actively. Like you said, it's a combination of the algorithms, the AI, the computer technology, and Vanguard professionals monitoring this and giving recommendations. We can add to it. It just extends the life of the tax loss harvesting ability. And yeah, really what we're looking for is to track the index, to do just no better, no worse than the S&P or whatever index we're tracking, but be able to realize some pretty significant tax benefits along the way, again, depending on what the market does and what the individual names do. Is that a pretty fair summary of what the offering is?
It certainly is. I couldn't have summarized it better myself. So yeah, you hit the nail on the head.
Fantastic. Awesome, guys. Was there any other kind of thoughts or points to make on this?
No, I think we touched on everything. I think to your point on the cost, 20 basis points is a lot lower than what it used to be. So we like to think we kind of moved the industry forward from a cost standpoint. And it caused a lot of people to lower their costs for this strategy as well. So we're really excited about that. And it's only for a subset of individuals, right? So this isn't a strategy that is for everyone, but there are a lot of investors out there that it makes sense for. So we think it's a great solution and we're excited about the future of it.
Awesome. That's great. Well, talk to your advisor if you'd like more information. And I know these guys have done this for my clients, so they're very generous with their time. They will happily run a scenario for you to see if it makes sense for your specific situation. And yeah, this is just another tool in the toolbox of ways to diversify, help with taxes, and really help our clients achieve more time and more money, which is our mission and goal here at 25 Financial. So Keenan, Patrick, thank you so much for your time. And yeah, we look forward to talking to you more about this in 2025 and beyond.
Thanks for having us.